Okay. Good afternoon, our viewers. This day we are here live again at another interesting episode of Insights from Eximators Legal. I'm here again today with Barrister Adedamola Abe. My name is Esther. You're welcome, Barrister Damola.
Thank you, ma. Thank you for inviting me once again. Good afternoon to everyone out there.
Yeah, hopefully she will be a regular feature for a while. Thank you. Also today, we're going to be discussing an aspect of banking law, which is actually the secured credits. And majorly, of course, this is a very wide area in banking law, but we'll be focusing on mortgages, under secured credit transactions under the banking law. So, as we all know, normally when people take out loans in the bank, there's always a security, to ensure, that the debtor will eventually pay up. And if the debtor does not pay up or is in default, there will be something the bank or the financier can have recourse to, like an asset of the debtor to be able to recover the loan. In most cases, mortgages has to do with properties being used as a lien, as a collateral. So the bank has a lien on that property, and eventually, in the event that the debtor, when we say the debtor now, the person who took out the loan, in the event that the debtor is not able to pay, then the bank can foreclose on the property. Most of the time, especially in Nigeria and other developed economies, is either building or lands, that are used as securities. So, majorly, what are mortgages? If we can just, what's the simple definition, the academic definition of mortgages?
Okay, and thank you once again for having me. So basically, when you say mortgage, it has to do with the use of a property as a security. It's like you are using security as a guarantee for repayment of a loan. Before now, what people sometimes use is personal guarantee, like, oh, I'm borrowing money from you, then I'm giving you an assurance that I will pay back the loan. But that has failed, because if someone tells you, if as a money lender, or like I see discussed today on this section, as a money lender or as a financial institution, or even a private individual who is into the business of borrowing people money, if at every instance when you borrow people money, what they keep telling you is, oh, I'll pay back the money, if that is the only assurance that you have as the basis, if that's the only thing you are relying on, you are falling back on, it's a very dangerous one. Because even when people have the intention to pay back, circumstances beyond their controls can happen, which makes it unable for them to pay back what they've agreed to pay back. So this is why mortgage is being introduced. So this is why you see people taking up a loan, and in exchange of that loan, you release your property. So at the inception, you are not saying, give me loan, let me give you my property. So it's not like a trade by barter thing. So it is, give me loan, let me give you my property, or let me drop title document, we'll still get to that. So let me just, this is a property, I have this property, use it as a security, just like you talked about when you were introducing the topic, like something to secure the transaction, to say, oh, if I fail to pay this money, then you can take over my property that I've given to you. So mortgage basically is a relationship between a money lender, a borrower, and a money lender and someone who is and the borrower. So between the person who is advancing money and the person who is taking money, with the understanding that you take my property, you give me money, take my property in expectation of repayment. So when I pay the money, you give me back my property.
Thank you very much. So basically, it's the transfer on ownership of the assets, from the borrower to the lender, pending, the payment of the loan. So eventually, the property or the land or building whatever is used as collateral can eventually be redeemed.
Yes.
In the event that the borrower pays up the money. But if they don't pay them up the money, then definitely the bank will have to for sale. Yes, the property. You mentioned something, and I've seen that happen. In reality, mentioned personal guarantee. Even these days with companies, when banks lend companies money, they still take the personal guarantee. Even with collateral, they still take the personal guarantee of the director or the owner of the company, because that's too. Most of the time too, these days, yes, land building appreciates.
Yes.
At the same time too, it might take forever for the bank to sell the property to be able to recover the money.
Yeah.
So these days, I think banks have also wisened up, in facility transactions. When we say facility transaction now, we're talking about loan facility transactions. So in terms of getting the personal guarantee of the maybe the directors or the majority shareholders in that company. Okay, thank you very much for that. So what are the types of mortgages? And there is the issue of, before we get to types of mortgages, I just want us to basically define, the terms in a mortgage. Who do we refer to as the mortgagor? Who do we refer to as the mortgagee?
Okay, the mortgagor is the borrower. Is the one who is giving out his property as a collateral. So the mortgagee is the bank or the financial institution, or if it's a private individual. So anyone who is giving out credit is a mortgagee. The mortgagor is the one releasing his property, his own property as a collateral.
Okay, so what makes the mortgage really is the asset, the property involved.
Yes. So if there is no transfer of title, if there is no deposit of title document, or any transaction, any credit facility transaction that does not revolve around the use of property as a collateral, you can't say that is a mortgage.
Yeah,
not a mortgage.
So it's the property.
That's what makes it a mortgage.
And I've actually seen, based on some scholarly contributions, they say that one of the essential features of a mortgage is the conveyance, of either the legal or equitable interest in that property to somebody else, Okay, all right. Thank you. So what are the types of mortgages, that are recognized under the law?
Okay, we have two types basically, and that is legal and equitable. So when you say something is legal, it means that it gives you you've met all the requirements. So we've defined mortgage as a transaction or as a relationship between a money lender, a borrower, someone who is advancing money, a creditor and a debtor, giving money to someone in exchange of a property, with the understanding that upon repayment, you give me back my property, you pay me back my money, I give you back your property. That is mortgage. And there are ways in which you can create it, like legal ways, because even though a property is given to you, that doesn't give you an absolute right. So they are laid down their requirements, their procedures. So when you meet all those things, then we can say, oh, this is a legal, it gives you all the legal rights, so you can exercise all the rights of a mortgagor, rather. Then if it is the other way around, the equitable mortgage, so this is saying that, we understand that there was this arrangement between you, but because you failed to do one or two things, because you failed to comply with the requirements, because when we talk about equity, so it's just let me just put it this way. The law says this is how you should go about this. That is legal. If you fail to do it, then you can't boldly say I have this right. But then equity comes to say, by the time the money was advanced to you, so equity now is saving the borrower, the lender. Equity comes to save the lender, to say, fine, this money has been given to you. So as a borrower, you shouldn't take advantage of the omission, either voluntary omission or unintentional omission, or something that you didn't intend to do. So equity now comes in to say you've collected this money. At the time of collecting the money, you promised this person that you do this. So, but because you failed to do one or two things, you shouldn't benefit from that wrong. So that's why we have equitable mortgage. So it is not to say that equitable mortgage just come in to say, oh, you failed to do this. But because it's just like if you are going to Lekki, instead of it like there's a road, you know, you have to go through. You either go through Third Milan Bridge, or you go through this other bridge, this bridge that is close to Ikoyi.
Western Link Bridge.
Yes, that link bridge. So those are the regular places that you should go through. But then when you miss your road, it's just like if you are going using Google Map. When you miss your road, it like reroutes your distance, directs you again. So that's how I can link equitable mortgage. It says that okay, we are going to Third Milan Bridge. This is where you have to pass, but you've missed your way. You've missed your way, but you are still going somewhere. So we won't say because you've missed your way, you won't get to where you are going again. So take this other road. So that's just like a simple definition of equitable mortgage. You've missed to do something. You've omitted to do something. You failed to do something. Or you even did it, but you didn't do it the right way. You didn't perfect it. Then equity comes to aid you.
Yes, exactly. So the major difference between the legal mortgage is the perfection element
and the mode of creation.
And the mode of creation.
Yes, because when you talk about legal mortgage, it means that you've complied with how it should be done. So when it comes to mortgage transaction, so we've talked about that it is an understanding. So you need to document it. So it's not just enough to say, oh, borrow me this amount of money. I have this building at this particular place. This is my title document. You show the person that you have this property. Then you give the person, like, let's say, a copy of the title document. But you didn't document the transaction.
So that person has an equitable interest.
Yes,
in that
yes, you have
you
don't have a legal interest. So the law also says that for you to say you have a legal mortgage, you have to register it. You have to register the mortgage. You have to.
So where do we register?
At you can register at the Ministry of Lands. You need to notify them because these are places where people conduct search. And when the search is done, if there's an interest on the land, then you can know that if you boldly see if that property has been used as a mortgage, you boldly see that, oh, this property, there's a mortgage transaction or someone has an interest. But when you fail to do that, even when you've prepared the document, you have everything stamped and all of that, but you fail to register it, so it passes as equitable mortgage. So even though you started as almost what looks like a legal mortgage, but because you failed to register it, you have the document, you have everything signed, prepared by a lawyer, even like we have it prepared by a lawyer, you signed it, you've advanced money, you've done all this, but you failed to register it, then it passes as a legal as an equitable mortgage.
So before we talk about how you create equitable mortgage, because there are ways to create equitable mortgage and there are ways to create a legal mortgage. Before we talk about that, I know and I understand that, you know, even in syndicate lending, when we say syndicate lending now, where there are different financial institutions that advance money or give facility to a particular personality, most of the time companies, you know, at times it's only one property that the company gives to maybe like 5 banks.
Yes.
You know, but of course there'll be evaluation, you know, that would have been done, and the banks will know, okay, yes, even if you collect 100 million from me and you collect 100 million from the other bank, at least whatever, even if we sell the property, we will still be able to recover our monies. So most of the time, the mortgage is created with a trust, like a trustee, who now takes over the assets of the company instead of the title deed being with, you know, one bank and is not with the other. Because if a company borrows money, maybe for its most of the time for machinery, fixed to run, not with working capital now, but maybe for majorly to buy machinery and all that. And at times the company can be advanced a loan of about 1 billion, 2 billion, you know, by like 3 separate banks in total. And at the end of the day, you cannot say, okay, Bank A gave 100 million, Bank B gave 500 million. So because of that, the title deed should be kept with Bank B because their money. No. In such cases, most of the time, what is advisable and what is being done in practice, you know, standardly, is for that company to create a trust, and give its title deed, to that trustee, and make the trustee the first loss payee, with the insurance company, so that whatever happens, if the company goes to one bank to go and borrow money, the trustee can say, okay, yes, okay, they have interest in bank A, B,
yes,
and okay, yes, we can still accommodate, and that's very, very important. So how do we create equitable mortgage? How do we create legal mortgages, especially in this jurisdiction?
Okay, so talking about creation of legal mortgage, like I said, there are different. There's actually like one. That is when you do like you create the mortgage in line with laid down provision. So we have different provisions. So it depends on the jurisdiction again. Some jurisdictions, they tell you have to do it by assignment. Some will have to do it by sub-demise. But everything is just in form. That's just a form. But when you have the loan, the mortgage document prepared, either you do it by way of sub-demise or assignment or demise, depending on the jurisdiction. Because what is obtainable in Lagos State is different from how you create it in the east or even in the northern part of the country. But one common thing is it is a transfer of ownership. That is the common feature for all of them. Either you are doing it by sub-demise or assignment or demise. It is a transfer of, you are transferring your unexpired interest, because going by the provisions of the land users, everyone who has the land or who owns the land, you have it just for 99 years. Because you don't have absolute right to land. The government owns it. So you only have the right to use it for 99 years. So when you are entering into a legal mortgage, you are just transferring the unexpired residual. That means, okay, government has given you 99 years to use this land. You've only been in possession or you've been exercising your right as the owner for let's just say 20 years. So you still have 79 years. So you are transferring the unexpired part. Like the remaining tenure, you are transferring it to the mortgagee. So if irrespective of the jurisdiction you are doing this, you have your document, everything prepared, and it is signed, then you go to the land registry. Like I said, you have it stamped. You also need to obtain governor's consent too.
As if you are getting a certificate of occupancy.
Yes, so you need to obtain governor's consent. Because even in Lagos State, they even made it like a compulsory, so you have to register it. It has to be registered. Even for equitable mortgage in Lagos State now, you have to register, even though it's an equitable mortgage. Because we've seen cases where we still talk about how to create an equitable mortgage. Even though you deposited your title deeds, Lagos State, going by the Lagos State mortgage laws now, Mortgage and Property Law of Lagos State, MPL, it even now says that it's not just enough for you to drop title document. You should, alongside, create, almost do it as if you are creating a legal mortgage. Prepare the documents, the mortgage documents, have everything prepared. But now you now have a memorandum to say that in the event that I fail to pay, then the equitable mortgage will pass as like you are converting it to a legal mortgage. So you already have all the documents prepared. So when you fail to pay, so because the issue with equitable people that have equitable interest in properties is sometimes when you now say you've deposited your title document, you've given it to me, now you fail to pay, come and execute the transfer documents. Yes, you won't find them.
Nobody wants to
yes.
their property.
So that's why Lagos State now, as it, even though it is an equitable mortgage, you need to register it.
And then definitely they've invariably made it a legal mortgage.
Yes,
because kind of.
But then it is only upon, it is only when you fail, when you default in making payment, that's when that provision of because you've drawn a memorandum to the effect that when I fail, then all these documents that we've signed already, then you now perfect and all of that.
Okay, so initially you may not perfect until there's a default.
Yeah, you have to. I'm just saying that's when it will now become yes. So another thing is an agreement to create a legal mortgage. So this is still something that you see in other jurisdictions. Lagos State has just made it a requirement that agreement you need to. It's not just enough to just drop your title document, but you should also have like the mortgage documents almost prepared, have everything ready, and drop it, register it at the land registry, so that someone who is also coming, though if anyone for that particular property, if you create a legal mortgage on that particular property, the legal mortgage will still prevail.
Yes, against the equitable, in case they go to court.
Yes, the legal. So that's another thing that you need to know when you are creating a mortgage. If someone, just like the instance you gave, where someone like a syndicate transaction. So if, let's say, even if I'm the owner of the property now, I have a land. I've obtained the land is worth like, let's say, billions of naira, and I want to take loan from different banks. So I've created legal mortgage. I've created this one, and you cannot just continue to create different mortgages. So it is always the first in time.
Yeah, they're previous.
Yes.
But I think that's why these days the idea of putting the property in a trust comes in. Because then when you now say, okay, first in time, then it's not the, okay, which bank did first of all advance money, or which bank first of all perfected.
It has to do with perfection. When it comes to mortgage, it's always, when the principle of first in time is not even first to disburse money. It is first
to perfect.
Yes. So that's why it is always advised that when you create a mortgage, when you enter into a mortgage transaction with someone, have it registered. I will always advise people to like register him, because it is the first to register. When we want to look at, oh, okay, fine, you still get your money because the property is worth, like, it has a good value. You still get your money, but then when you want to consider who are we paying first, it's the first to register that will be considered first. So that is to say that for equitable mortgage, you can either do it by depositing your title document, which does not transfer ownership. So it's just for you to say, okay, these are the originals, have it.
Just keep it in your custody.
Yes. Then with a memorandum to say that, and it is not just for you to just drop title document. There should be an intention. So it's not just for me to say, take my title document. There should be an intention. Okay, why am I giving you the title document? Why am I passing it to you? It's because I've given you a loan.
Because there will always be a loan agreement.
Yes. So I've given you this loan, and in the event that I fail, then you can dispose the property. Then some people also do it by also entering into an agreement to say, I want to enter into a legal mortgage. Once you fail to perfect, once I fail to pay, then I create a legal mortgage on the transaction. Then another thing is people also do it by way of entering into power of attorney. So that's another way too. Some people also do it by power of attorney to even say that, okay,
is it the legal mortgage now? The
equitable, they say that I give you power to sell. So it's not a transfer. It's not a transfer, but it's just for you to show, like, just give this person an interest that, okay, I'm giving you a level of control over this property. But when it comes to legal mortgage, it is like doing things the right way, having your mortgage document prepared, transferring ownership. So that's like even the key word between equitable mortgage and legal mortgage. When it comes to legal mortgage, you've transferred ownership, you've transferred all your rights, but it is not going to come into effect until there's a default. But when it comes to equitable mortgage, you are not transferring anything. It's just like an intention to say, okay, when I fail, then we can now talk about enforcing or anything. So you can't enforce. So when it comes to legal mortgage, once I fail to pay, because ownership has been transferred to me,
so
I can take possession of the property. And for both equitable and legal mortgage, during the tenure of the loan, you don't take possession.
Yes,
So both of you might even think, oh, you might not even know who has an equitable interest or illegal yes until there's a default. So it is when there's a default then I can enter into possession. I can take, because I can exercise all the rights that the owner of a property will exercise. I can sell, I can take possession, I can do anything. Yes, but for an equitable mortgage, you cannot take possession of the property. You have to go through the way of the court before you can do anything. So anything you want to do as an equitable mortgagee, you need a court to back you up.
Thank you so much, for that insight. And basically, I've seen, in practice, really, that there are times, even when you have a legal mortgage, it does not mean the mortgagor is not going to pay. Because most of the time, the mortgagor pays, and there's always a deed of release that has to be signed, by the mortgagee to release the property back to the mortgagor. And this is very, very important. Because a lot of times, the person finished paying, if the deed of release is not given, then the bank still claims that yes, they are still, the ownership of the property has been transferred to them, and it can be very, very dicey. So I think the issue of the deed of release, when the loan has been fully liquidated, is very, very important.
That's even part of the covenants that are always in a mortgage transaction, to the effect that the property will be released to the owner upon payment. So that's the beauty of mortgage. So it is always that, okay, you are passing this thing to me on the condition that I will pay. So that's what they call Caesar upon redemption. So once you redeem it, it is only when you fail to redeem, that is when I can now exercise either my rights, the rights that are conferred on me as a legal mortgagor, or as a legal mortgagee, or rights conferred on me as an equitable mortgagee.
Yeah, but the deed of release, I think, is also registered.
Yes.
That makes legal mortgage very cumbersome, and that's why most times, most banks don't even want to go through
they don't like until you've defaulted.
Because with legal mortgage, you have to go through the whole story, governor's consent, signing this and that, going to land registry, and it can take 2 years to even register and go, especially in this jurisdiction. And at the end of the day, the mortgagee or mortgagor rather finished paying, the company finished paying the loan, and now you still have to now go and register a deed of release again.
Even interestingly, like just this last week, there was a particular money lending company that reached out to us. Someone approached their company for facility, and it's just a 6-month tenure. And when we were talking about, because it was a property that was to be used as so we have to advise them on how to best protect their interest and all of that. And when we asked, what's the tenure of the loan? 6 months repayment. And even when we reached out to allow and okay, if you want to, okay, fine, we want to protect this client. They are using this property, we want them to like do the normal listing, register and all of that. The timeline they gave us for registration, it would have finished making payments, and so if you are saying you now want to perfect, payment has been completed, yet you have not even gotten halfway into perfection of the transaction. So we just have to give creative ways on how to do it.
So, but in that kind of instance, they can create an equitable mortgage without submitting the title deed that is for the period of the tenure.
Even for that, we even consider the option of putting a lien. Okay. Like a caveat, putting a caveat, because you can also do that at the land registry too. So if you know that, oh, this tenure is not, you can put a caveat. That's one of the ways of protecting yourself. So the land registry will place a caveat on that land.
That property.
Yes, so even though you don't have a mortgage registered, but then anyone who wants to transact on the land, we always see that caveat once they do a search. Okay. Once they run a search at the land registry, they will see that caveat that there is at least someone has an interest, or maybe there is even an issue, or there's, and once you see that caveat, you are given notice. Yes, you are given notice that, oh, there's something on this property. Even for that caveat, the tenure to put the caveat is almost equivalent to the tenure of the year. It's almost for them to wrap up and all, and the cost again.
Yes.
So the cost is, by the time they calculated there is going to cause them to do all of that. It's not worth even the amount of loan. So this is some of the issues we've had to interface with, and even money lenders and financial institutions. These are some of the issues, some of the reasons why it is not the joy of a money lender to know that if I don't perfect this mortgage, I'll have issues. So it is not their joy to just leave it open like that, but looking at the circumstances, and as someone who is even borrowing money, they are saying you should, on a facility that is not very high like that, and you are saying pay millions of naira for perfection. Person can even go to meet another money lender that is not
keen on
yes.
thing, yeah.
So sometimes money lenders are always very careful. They are at a very tight corner on
whether to make it a legal mortgage or whether to find ways to protect.
Yes, to just manage deals.
Yeah, and that's very, very interesting to note. So, what are the merits and what are the advantages, of having a legal mortgage, as against an equitable mortgage? What are the advantages of an equitable mortgage as against having a legal mortgage?
Yes, the advantage having a legal mortgage, it's the best way to protect yourself as a money lender or financial like that's the best way, because you have the assurance that when this person fails to pay, you can easily get your money back. Once you do, you even recover it within the bounds of the law, because for you to even say that your power of because one of the rights of a legal mortgagee is the power to sell the property, to dispose it when the mortgagor fails to pay. So, and before you can say that power as a reason, when you are fully vested with that power to sell, there are conditions. The loan must have become due, or maybe an interest or a part of it. You've made demands and all of that. So if there are three different instances, so if all of these instances have been met, then you can exercise your power of say. And you can even say it as a reason. So another thing is for you to even exercise it again, there's another condition too. So there are two different things, that the power as a reason, and that now you have that power to sell and you have the power to exercise that right. So it's just like when you say you have the right to do a thing, do you have the right to do it at that time? Because I can have the right to sell your property, but the timing of selling it, is it right? So as a money lender, one of the merits is that when you have a legal mortgage, if that is what you execute, or if that is the agreement between you and the person you've advanced money to, you have the right to exercise the rights that that a legal mortgagee can enjoy, and that is the right to sell, right to enter possession, and you can even foreclose the person too from repaying. That is another right. And this right to foreclose is also applicable to an equitable mortgage. So when you talk about foreclosure, you are saying that the timeline to even pay, fine, the timeline has expired, but you don't have any grace again. So the timeline has, for you to pay, so you can't come back to say, oh, yes, I've defaulted in paying this loan, I want to ask for 10 more years and the like. So you can foreclose the person so that the person cannot redeem the right to pay. But that right against that, it can.
It's that not denying the mortgagor, the right to pay, because basically there's a right to pay.
Yes, I'm saying, let's say you have a loan you have a tenure of 10 years.
And the tenure has expired.
Sometimes you can still plead for more time.
Yes.
To repay. But as a legal mortgagee, I have the right to one of my rights is the right to foreclose you.
Yeah.
From even extending it again to another year. Yes, I can foreclose you, and there are procedures. You can either be nine-side, just like you have in divorce, and decree nine-side, decree absolute. So, and even when it's absolute again, because the law too, sometimes too, because
It wastes things.
Yes, waste things. So sometimes, even though the right has been foreclosed absolute, it can be reopened again too.
And depending on the circumstance of the mortgagor.
Yes, it can be reopened, especially when that foreclosure was obtained in a very illegal way, so it can be reopened again. So,
but do they have to go to court? To get that right to foreclose? It's not going to be in the agreement between the parties.
No, it is the court that does that.
Oh, okay.
Yeah, because there are procedures. You have to file an application to court. Then another right that you stand the chance of enjoying as a legal mortgagee is the right to appoint a receiver. Just like talked about trustees, you can appoint people to be in charge of the property and get proceeds and all of that. So then, as an equitable mortgagee, another right that you have is you have a right to enforce the covenant to repay, because now you've entered into the agreement. So, like we said, equity now comes to say, I've given you this money, so you should pay me back. So I can go to court to pray that the court should compel you to give judgment to pay. Then I have the right, I can garnish your account too. Then you can also exercise your right to also to foreclose the person from paying, so that you can enforce the mortgage agreement between both of you. Then you can also ask the court to also appoint a receiver too. So, but the major thing is when you are a legal mortgagee, you have the liberty, like you are free to exercise this right without even approaching the court, except maybe when you want to go the way of foreclosure or receivership. But if it's just for you to enter possession, sell the property, get auctioneers and all of that, you have the liberty to exercise this right of sale. But as an equitable mortgagee, this is the demerit. You don't have that liberty.
You have to approach the court.
Yes, you have to approach the court.
Okay. Yes. That's very interesting. Thank you so much. And
thank you.
When we talk about you mentioned garnishing the account. Yes. Because most of the time when the bank advances loan, of course, if it's between a company now, it's expected that the company has a bank account with the financial institution anyway, and whatever proceeds comes in is like the bank is getting its repayment from whatever is coming into that bank account. So when you now talk about garnishing the account, is it garnishing all the other accounts the company might own or the person might own in other banks?
Yes, in other banks.
And they have to approach the court to get that garnishing.
Yes, there's even this. I think maybe last year or 2 years ago. I can't really remember the year now. CBN passed a regulation.
That's the central bank.
Yes, central bank. It passed the regulation to the effect that, and the essence of this regulation is to allow financial institutions to recover money, in the process of recovering their money, to deduct money that you have in other banks.
Yes, I think they did it.
So they said that all loan agreements should have that clause. You should have that clause there, because we've seen cases where, just like you said, it's expected that if I obtain facility from a bank, I should maintain an account with them that I credit, where they get their money back. So we've seen cases where people will borrow money from a particular bank, and once the money is disbursed to them,
they move it to elsewhere.
They move it to another bank, and they stop operating that bank account. They start operating another bank, and before that bank can enforce their the repayments and all of that, they now have to start going all the way, and because you cannot just lay hold of money that is in another bank. So the CBN now made it like a recommendation that for every loan transaction, you should have a clause to say that the bank has the right to place a lien or to recover the money from not just your accounts with them, but from any other bank where you have accounts. So let's say, for example, you took loan from ABC Bank. You have like 50 accounts in CDE, FGC, bank, like 10 different banks. So the bank now has a right to enforce that loan transaction once they know that you have money in the account. So they can just...
So they garnish all the other accounts. Yes. And I'm seeing, the reason why these days when companies are opening accounts, the account opening form now, especially in Nigeria, it asks you which other banks do you have accounts, and it asks you for the account numbers. So now I don't understand.
Even when you fail to do that, they can even get it with BVN.
Yes, they can get it with the biometric verification. Yes, okay, that's very interesting, and you know it gives caution both to the lender and to the borrower as well. So before we go, is there any advice in practice you will give lenders and you give borrowers, in terms of when it comes to mortgage, having discussed the legal and the equitable side?
Okay, basically my advice let me start with money lenders or financial institution. My advice is that before you even enter into a mortgage transaction, do your due diligence. So be sure that it's not just enough for you to even create a legal mortgage, or the facility has been given to you, or the property, the person is even willing to pay all the money and all of that. You do, like, you perfect the mortgage, it's a legal mortgage. But where there are successive legal mortgages, so let's say the person has used the property as a mortgage in different banks, and those ones are legal mortgage, it is those ones that will be prioritized first before it gets to you. So before you even enter into any loan transaction, especially when it is a mortgage transaction, do your due diligence. Get lawyers or professionals, or you even value the property, because you can even be given a property, and let's say you're advancing a loan of 100 million, and the property that is being given to you is just 50 million. Even when you enter into a legal mortgage, you have the power to sell and none of that. You exercise everything. You sell, the best you can sell it is for 50 million. Then the other 50 million, you start chasing the man. So before you enter into any mortgage transaction, do your due diligence very well. Visit the land registry, visit the Surveyor General's office, visit CAC, because even the companies Akinleye-Martins that for companies, incorporated companies in Nigeria, it is one of the requirements is that when you use the company's property as a charge, because that's one of the ways I omitted out. That's one of the ways you can also create a mortgage.
A charge.
Yes, a charge. Yes. Because even the companies Akinleye-Martins that it defines charge to mean a mortgage. So you won't really see the use of the word mortgage in Kama. What you see is charge. So even a mortgage under companies Akinleye-Martins that is defined as a charge. So when a company has used their assets, it's expected that you register it with the Corporate Affairs Commission with the register of charges. In the register of charges, you have it registered there to say that this particular company's asset has been used as a mortgage. So you need to register that. You need to do that search. So don't just stop your search at the land registry. Don't stop at the Surveyor General's office. If it is a corporate entity, also extend your search to the Corporate Affairs Commission to know, because there was a time sometimes last year, one of our clients who also wanted to purchase a property, and it was a company property. We had to do a search, apply for search and all of that at the Corporate Affairs Commission. And we saw that that particular property was used as a mortgage property at a particular year. But the beauty was that they've paid the loan. So when the loan is paid to...
But the deed of release was not registered.
No, yes, it was. The thing is, when you conduct a search at CAC, when the loan is taken, you will see if it is registered with CAC. You will see it there. When the loan was paid and property, everything was transferred back. Everything is there too. So that was what we saw in the search that we did, because you have to do a comprehensive search. You cannot just do a short search. It's a comprehensive search where you will be given the company's file. You check through all their documents. So we saw that at the time, the company's property that our clients wanted to buy was used as a collateral, and it was like they paid back and the property was returned back to them. So just imagine that the company took the loan, but they didn't pay. At that time, we would have been able to advise our client, oh, there's a charge or someone has an interest on this property. It is not a good one to buy. So that is just always do your due diligence. That's like the only advice that I will give money lenders. And for borrowers too, don't be in a hurry to give out your property too. Be sure that the property you are giving out, let's just look at the situation, because some financial institutions are greedy. I can say that. So let's say you are taking a loan of let's say 5 million, and you are dropping a property worth 100 million. Some financial institutions will frustrate you. They will frustrate repayment to the extent that you won't be able to pay.
Because they'll be adding a lot of interest.
Yes, and they already know that, oh, this is a property that if they should lay their hands on it to sell it, they will make good money from it. So you keep seeing different interest rates, and at the end of the day, they'll frustrate repayment to the extent that it now become a legal matter. We will have a client like that too, because even the amounts because they kept paying, the matter is still in court, we have to challenge, they kept paying and paying and paying. And it almost looked like the debt is not going to end. But because the property is high value. So just sometimes it might not, going the way of mortgage might not really be a good one. If there are other ways in which you can secure the loan, you can go the way of, let's say, personal guarantee, like we said, instead of just
but it depends on if the mortgagee is going to take that personal guarantee or not.
Yes. So just ensure that you are not giving too much as a borrower.
Okay. So thank you so much. So we've seen that there has to be a balance, and yes, legal mortgage actually is really the most secure and comprehensive way, to actually secure interest. Under secured credits, really, as it transfers ownership, immediately as well to the mortgagee. However, the way and manner in which even the mortgage property is being handled is also very important, by the mortgagee, because if it's not handled properly in terms of maybe necessary documentation being done, it could create a liability even for the mortgagee, even though yes, you are the lender. So definitely, both the lender and the borrower, they have their parts to play. So today, we want to say thank you very much for this discourse. It's actually been a very insightful one, and I believe our viewers have actually been enlightened, especially those who are looking into maybe who have companies and they're looking into using maybe a property to secure a loan transaction and all that. There's always the need to be very, very careful. We have seen also that even financial institutions too, they could have their wrong motives, one is very careful. So you have to dot the I's properly and cross the T's, and also look at the cost effectiveness, in terms of whether it's actually cost effective to perfect the mortgage, now, or create an equitable interest pending, if there's going to be a default or not. Of course, no borrower sets out to default, ideally. Ideally. No borrower sets out to default. So thank you so much. And our viewers at home, thank you for joining us today. We believe that we've been able to take you on a good ride, of understanding and having an overview of mortgage transactions under secure credits. Until we come your way again next time, say thank you very much and have a blessed weekend.